Good morning, everyone. It is Sunday, May 20th. Yeah, May 20th, 2018. It's the Gold Goats and Guns Hour here on YouTube and Periscope. We're simulcasting out via Restream.io. Really like that, the ability to do both of those things at the same time. It really makes life a lot easier. I can then serve both markets at the same time. So, want to talk about what happened last week in the markets relative to all the geopolitics. We've covered the geopolitics in past live streams, both here on YouTube and on Periscope, and you can check those things out. Good morning, Buck. How are you? I hope you're well. Missed you on Friday night. They got a lot to talk about because I want to talk about the markets primarily today. I want to talk about the way that this is beginning to play out. I don't want to get into the particulars of what's happening policy-wise relative to Donald Trump and his handling of geopolitics. I don't think that that's the right focus for today. The right focus for today is to look at, now that we've seen these major events. Italians forming a coalition, Trump pulling out of the JCPOA, the European leaders holding a summit stating their opposition to Trump's Iran policy and the sanctions, and Merkel meeting with Vladimir Putin, and Putin meeting with Assad and from Syria, and all this stuff is happening. It's very, very important, and it's all interesting. But we're now, because all these things have happened, we're now starting to get an idea of what effect it's going to have on the financial markets, because that's ultimately where a lot of these battles are going to play out, and why it's important to us, not just intellectually, but from a capital perspective. So, and how are we going to manage and navigate our way through this as investors and as rational actors? Okay, because at the end of the day, we're staring at a potential long-term sovereign, we're talking about a potential sovereign debt crisis unfolding in Europe, and that's going to have an enormous effect on whether or not you should be focused on the return of your money versus the return on your money. So I want to go over those things today. So last week, I've been talking for a couple of weeks now, and this has been the general chatter in the marketplace, that we're running up against a very important technical level on the you guys are funny. A very important technical level on the U.S. Treasury 10-year note. And that if you look at a long-term chart, which I'm going to put up in a couple of minutes, of the U.S. 10-year, you'll see that there's a major high at around 3.05%. And I've been saying both publicly and privately on my private blog for my subscribers over at Patreon that level and a weekly closing price above that level is important, because it now signals a short-term or medium-term, depending on how you want to define those terms, potential for a short-term push well above that level. Now that we've gotten a technical weekly close above that, that's going to give bond shorts but it's going to give bond shorts the what's the word I'm looking for? Enthusiasm or spine, sack, whatever you want to call it, to try and take rates up to 3.25 or even 3.5% on the 10-year. And that would likely mean then that would likely mean that we're staring at the beginning of a long-term, or at least I'd say medium-term, bear market in U.S. Treasury rates. Everything's lining up for that anyway. The Fed is raising interest rates. They're normalizing their balance sheet. Dollar liquidity is drying up. I've been talking about these things for weeks. The market is prepared to take rates higher, but we've never had a moment where we get a technical breakdown on the U.S. 10-year note. And if this is that moment in time where we're getting the first real confirmation of that, of a technical breach that everybody can see. I'm not the only guy seeing it. Everybody can see this. Bill Gross has been screaming about this for weeks now. He's been out there in some ways torching his reputation, saying the bear market in bonds has already begun. And he said this like 3 times over the last 18 months. And he's been wrong because we haven't actually gotten the confirmation that the long-term trend has changed. And for that to happen, it first starts with a weekly close above a very important technical level, and then you need a monthly close, and then you need a quarterly close, and then ultimately you need a yearly close. Because when you're looking at the big trends in markets, the trends that politics has the most effect on. Now, politics doesn't really change the day-to-day movements of markets. I mean, markets react in the moment to what's said, to the headlines, to this, that, and everything else. But that's mostly just positioning. That's guys / computers / funds, whatever, trying to just scalp whatever arbitrage of the moment that they can get. But none of that stuff alters the overall trend. Okay, none of that day-to-day stuff, unless such a major policy decision is made and a cluster of major policy decisions are made that would then take a market as important as the U.S. 10-year note, which is one of the 2 or 3 most important markets in the world, and fundamentally shift its trend. The last time we saw a shift in trend of that nature in the U.S. 10-year note was when Paul Volcker was chairman of the FOMC and raised the prime rate to what, 13%? Okay. And that ended the last bear market in U.S. Treasury debt. That was what, 1981? 1980? I mean, it was insane. We're talking about, it's a 48-year policy. And so with that in mind, where are we now? So we closed this week at 3.06% on the U.S. 10-year. I'm not saying that we won't see a downdraft in rates at some point in the future if there's any kind of dollar liquidity spasm. That I'm not going to argue. It's very possible that we'll still get one last downdraft. But what you'll find is if we get all the technical reversals happen through the various time fractals, then all that will be is a retest of previous support before going higher, because we'll start to see, as opposed to a constant downdraft like that, we're going to start to see a random walk upwards in rates, and there will be even multi-month counter trend rallies in U.S. rates. It will happen. But we've seen multi-year counter trend rallies in the U.S. Treasury market over the last 50 years. I mean, there have been plenty of short-term bear markets in U.S. debt. Every time the Fed goes through a tightening cycle, you're by definition going to be getting a short-term bear market in U.S. debt. But the overall trend has been absolutely bullish on U.S. Treasury debt for the last 48 years. Yeah. So Ryan says you're not buying you're not buying it, and he has his own views. Interesting. If you can put up something specific that you think I can respond to, I'll be happy to listen to it. This is a Periscope comment for those of you on YouTube. And understand that this is not to say that I believe that I'm any kind of dollar bull. Remember, the title of this thing is Gold, Goats, and Guns, right? The point is that this is where we are right now. And that as bad as the United States finances are, and as bad as the level of indebtedness in the world is, the truth of the matter is that $21 trillion, and Martin Armstrong is right about this, $21 trillion in U.S. Treasury debt is nothing compared to the over $200 trillion in debt that the world has. And it's the ability to service that debt, even at higher interest rates, that should be that's what you should be asking yourself, is who's going to crack first. Because it's certainly not going to be the United States. We're only sitting here at 8.6% congressional on budget spending to service the debt at this point. When we go to World War III, the market will dip. Well, the markets will always dip on that kind of news. There's no doubt about that. But the real question you have to ask yourself is, are we going to see World War III? I'm not ready to make that argument today. What I'm more interested in is to watch the maneuverings, and I'm not going to get into this in detail today because I don't really want this to be about those levels of detail. I have previous streams that you can watch where I have a lot of thoughts about these, about what's happening between Europe and Russia and Iran and all that stuff. Did a really good one on Friday about that. If you're looking for a boonie hat with a neck flap, they're like $11 on freaking Amazon. Go buy one. So let's get to the charts real quick and let me show you what I'm talking about. Let me pull up the 10-year note. I'm going to bring up my desktop real quick, make things big. 1 second. Shift. There we go. All right, so when we look at, so that was a weekly chart. So you can see what I'm talking about here. We got a weekly close at 3.06%. This is obviously the highest weekly close that we've seen in recent times. But if we go back and we look at a monthly chart, you can see very clearly here that these are the highs from 2013. From the end of 2013 to 2014, this would be the initial taper tantrum, right? The initial when Bernanke in May of 2013 mentioned that he was going to start tapering off QE. We saw rates on the 10-year rise. Since then, I mean, for those of you who like to look at these things, this is a very kind of ugly, malformed head and shoulders pattern, which easily, well, not that I'm a big fan of that. It's for those of you who actually believe in that shit, which I don't, but you can see a head and shoulders here with a size of about 1.75%. So that's targeting a 4-year price target of around 4.75, 4.8% on the US 10-year. I don't think that that's even remotely reasonable. I think we'll see 4.8% on the US 10-year well before 2022. So I don't take much stock in those patterns, but you have to realize that we're looking at since Brexit, US yields have been rising. They're going to continue to rise from here. This is telling us that we could be getting some nasty feedback effect here from emerging markets having to start breaking down. Why do I believe that that's the case? Well, let's go look at some emerging markets. Actually, let's start with the euro. All right, I'm going to put up a big chart here of the euro. Again, not a huge fan of such technical indicators like Fibonacci retracement, but this is a good example of what I'm talking about. So here's the all-time high in the euro, circa 2008 at around $1.60, which is, by the way, what cratered Greece and Italy and created the budgetary nightmare that they're in now. The euro at $1.60 is purely a function of German labor competitiveness and dollar weakness during the 2008 financial crisis, and that actually is what gutted and created the European sovereign debt crisis that started in 2010. But what I want you to note is, look at the violence. When the euro drops violently. We're talking for $1.60 down to 125, back to 150, down to 120, back to 140, back to 148, down to 125 again, back to 140 very quickly. This is after the Swiss depegged, and then down to $1.03, and then another violent move back up to 123, and now we're starting to see another one of these waterfall unfold. And I think that this is your next big down leg in the euro is unfolding now. This is definitely a classic 2-bar monthly reversal, right here in April, May. So this is a monthly chart of the euro, by the way. So, and in any kind of classic sense, this is a dead cat bounce in the euro. from 103.5 back up to the 38% Fibonacci retracement, and now back down to this. So the next level to watch for here on the euro is 117. Just that simple. And it's both 117, it's first 117, and then I'm going to slide down here. It's this low right here at around 115.5. This is the real technical breakdown. If this low doesn't hold, we're going to see $1.05 on the euro. And if the euro breaks down from there, then that's going to be with a strong, that's going to be on the back, that's obviously going to be a stronger dollar scenario. And there's a great article on Zero Hedge from a couple of days ago, which I have a link to in the thing down below, in the description down below, talking about emerging market risk and how a strong dollar is creating a nasty feedback cycle. And it has to do with a record short position in the euro dollar markets, meaning dollars that are stuffed into European banks. We're sitting on the euro dollar futures market is sitting with an all-time net short position in the futures market there. And that's enormous, because if we start to get a breakdown in rates like this, while the long end of the yield curve may not, the argument, this is a guy from Deutsche Bank, the argument is that that all of this may not see a huge move on the long end of the US yield curve if, say, for example, the Fed starts to slow its roll on raising interest rates, but it'll drive up short-term rates rapidly, and we'll get a massive or an even further flattening of the yield curve here in the US, maybe even a potential yield curve inversion as a lot of foreign central banks dump U.S. treasuries to defend their currencies against a rising dollar. That's the scenario that's unfolding. And then when you start to look at what's unfolding in Italy, and this is where I gotta, and then let me pull up while I'm sitting here talking real quick. I'm going to pull up the Italian 5-year chart, but this usually takes a minute. Investing.com's bond database isn't particularly the bond stuff isn't particularly the fastest part of their database. So when I get to, and I'll show you real quick what I'm talking about. So let's look at that. I'm going to bring that back up again. Desktop, transition, go. So Italian 5-year bonds are now trading at over a point. It's not really interesting. The weekly chart is interesting. It's obviously, this move this week is enormous. It's a 25 or 30 basis move, 30 basis point move. It's obviously above all of these potential resistance points here. There was kind of a double top at around 97 basis points. Buy or sell oil. I'll get to that in a minute. Hisenburn. So Hisenburn is asking me whether or not I should buy or sell oil. I'll get to that in a minute. So looking at this situation, this is obviously a weekly breakout, but when you pop out to the monthly chart on the Italian 5-year bond, you're not really seeing anything all that interesting, right? We're right here at, if we close May above 1%, that would be a breakout from this range, but really the big issue is going to be 1.36. This high here, the March 17 high of 1.36% on Italian 5-year debt. If we get above that, things get really ugly. Things are going to spiral out of control in Italy really quick. And given the, and while I talk about this, I'll bring up the oil chart so I can, Hisenburn, you talking WTI or Brent, or you just don't care in general? Generally speaking, I'm geopolitically focused, so I can give a crap about WTI. I only care about Brent, right? So I'm going to bring up Brent because that's all I care about. So the Italian coalition that was put together this week between the League and Five Star Movement put together their list of demands, and none of them are good for the I'm going to go back to the me for a minute. None of them are good for the European markets and the European political situation, right? You've got a German electorate and German leadership that is steadfastly opposed to any kind of debt relief or debt restructuring. So I've been chatting with a very knowledgeable person in email for the last couple of days, and he read my article on Friday, and I took exception to some of the terminology and the way, and that article, by the way, just hit the front page of Zero Hedge like 20 minutes ago. And so we've been kind of conversing back and forth about the history of this and where we are. And he's German and a very astute observer of things. And so it's not a contentious discussion. It's actually one of those rare things when in internet discussion, it's two people who relatively respect each other's opinion, talking respectfully to each other. It's kind of cool. But regardless of that, that debt restructuring involves writing down debt that's owed, that's owned by the European Union, the various banks of the European Union, most appropriately the Bundesbank in Germany. There's absolutely no appetite for that politically. Okay, and then there's debt. Then there's debt repudiation, ultimately, or the other way around. So debt restructuring would happen through the ECB, and debt repudiation would happen against any bonds that are owned by the other central banks within the European central banking system. So the Bundesbank, the Bank of England, Bank of Spain, whatever. And at that point, you know, earlier in the week, there was the leak that the Italians were going to be looking for $250 billion worth of debt write-off in general, kind of like what Greece was asking for, about $80 billion in 2015, which obviously didn't occur. The Germans refused to budge on that at all. Finance Minister Wolfgang Schäuble ignored Greek Foreign Minister or Finance Minister Varoufakis, and yada yada yada. I don't know that that's right to assume. So user 13 is asking via YouTube, is it right to assume that, like Greece, the Italians have repaid the principal on their debt many times over? That I would not say. But I can tell you that the amount that Greece has been borrowing and the amount that they have in relative to their economy, they have. The Italians are in a different situation. But part of it is simply that a lot of that debt was issued when the euro was at 80 cents, then it doubled to 160, and then we're back to the same situation as today. The Italians have a lot more leverage in these negotiations with Germany because Italy's more important structurally to the European Union. Period. They have a lot more leverage over German banks and German politicians than they did than the Greeks ever did. So it's going to be interesting. And so looking at the proposal or the proposed governmental agreement and the policy points of the five-star league coalition government, it's pretty obvious that they're setting themselves in opposition while softening their language, but they're still just as staunchly setting themselves in opposition to Brussels and to Berlin as they were previously. They're just kind of couching it in nicer terms, so as to not spook the markets and so as to not spook the Italian electorate, who at this point are still not down with leaving the euro, even though the sum and substance of the proposal, which is what this individual and I, this German individual and I are chatting about privately, is that we both realize, we both agree that the whole list of demands or whole list of the program is completely unworkable. So without major changes to the rules and the political system and the political, and my argument to him, and he's much less sanguine about the potential for anything to get done. And I'm like, I believe firmly that Merkel will torch what's left of her political credibility and her political career for the EU. And if it means restructuring Italy's debt, then she'll do so. But what she's going to try and do, I think, is that what she's going to try and do is allow the Italians in some way to give her some political cover by lifting Russian sanctions, by backing the by standing up to Trump and backing the Nord Stream pipeline and whatnot. Should you sell your shares of the Qatari investment fund? If you bought it last summer, then I would say probably yes, because you've made a good bit of money on that. Hold on for a second. Let me pull up QAT real quick. But as far as oil is concerned, oil is overbought, I think, at this point. What I would say is there's a very good chance that we'll see a move. Okay, you see this bar that I have highlighted right here? Oh, you can't because I haven't put up the Desktop, yeah. So let me put up my desktop. Hold on. Okay, so looking at oil real quick, if you see this bar that I've got highlighted right here, I don't know if you guys can actually read that or not. I'll make it really big, but it's this bar right here. The low on that bar is 96.75 Brent crude. We're at 78. This is a waterfall here. There's not a lot. This is the waterfall collapse of oil from 2014. I'd say that you've got that with the negation of this reversal bar here and this jet higher and the political situation as it unfolds, as it's unfolding right now, it's very possible that we'll see a move in oil up towards $85 a barrel, and then we'll probably run into real opposition, possibly even as high as 96. But that's a very old bar. It goes all the way back to 2013. QAT. I have not looked at QAT in recent days. Let me look at it real quick. So, when did you buy it? It actually looks like it's setting up really nicely right now. So, QAT, when did you buy it? Are you sitting in a profit position? Because right now, with the move that they made to consolidate the position in Rosneft. Well, let's see. We got bottom down to 12.5, and then a 2-bar reversal, and then a 1-bar reversal, and then a 2-bar reversal. It's really kind of trading sideways. You bought in January 2017. Wow. If you didn't double down at the bottom in order to dollar cost average, and then you'd probably be sitting on a profit right now. I don't know, because it's looking to me like it could possibly be setting up. It's a really simple trade. If it closes below 16.39 this month, I'd probably say sell, and if it closes above 17.57, I'd say hold on to it, because you're range bound right now, and what you're looking for is to see if there's a monthly reversal signal, and a close below 16.39 in May. That would mean that we've run into resistance, and it's going to drop back to at least 15.39, and if not, it could go back to 12. But if you're going to move above 17.57, then not. Now, the Qatari rial is still pegged to the dollar. They never did kill the peg. So if the dollar starts to rise, you're going to get the Qatari stock market is going to rise alongside a rising dollar. It's not going to get gutted with a rising dollar because of currency effects. Okay, because the Qatari stock market is simply, you're going to get the currency effects working to your advantage. Okay, it's as opposed to being invested in euros right now and being invested in, say, something like a DAX index, a German DAX index fund, where you're getting killed in the currency arbitrage. Okay, so all right, I need to show you guys my email. All right, so let's go back to the webcam real quick. All right, so does that answer your question? I don't have a good read on oil at this point, to be honest with you. I think it's overpriced, but at the same time, politically, the Saudis want $90 a barrel oil, and Trump is doing his level best to give it to them. You want my honest opinion? So it's very possible we could see $90 a barrel, but it's holding up really well, and we're in May, so. Okay. Where are we here? 29 minutes. All right. So, when you look at things that way, and when you look at so we have that, and then if we take this one step further, one market I haven't looked at this morning, I'm going to bring that chart up real quick, is gold. Now, we had the breakdown in gold 2 weeks ago. Premium sitting 350 in Central Florida. It's almost I'm in Gainesville. Gainesville's always 10 cents to 15 cents higher than the rest of the state. Unleaded is 280 to 290 a gallon. So yeah, and we're easily seeing 350 already here. All right. Okay. I'm going to bring up the gold chart and tell you why this move below 1300 is so bad. So let's go back to the desktop one more time. do this again. All right, so again, investing.com, the gold chart. So this is what I want you guys to get a feel for. So, and I'm going to bring up the monthly chart because it's really important. I really wish I could get this overlay to go away, but I can't. Okay, so we have this low here on December 2016 low of 1046. We have this December 2017 low here at 1150, 1146, 1150, depending on whose future market you talk about. This is obviously this is investing.com's CFD, which tracks pretty closely to the COMEX and Shanghai. But if you look at what we've been seeing in gold since the Brexit high, which is this, it's 1374. It's actually really much easier if I just pull up a different chart, that my own personal chart of this. But you can see that there's a lot of highs here in this area, right? 1355, 1357, 1361, 1365. That this area, this high has never been bested. And we've had 7 or 8 times that it's failed. And this breakdown here below 1300, look at the chart, right? We've got a move up, a move down, no reversal here, trade sideways, breakout, 2 bars, nothing, trade sideways, and then a breakdown. So these are all, none of these are really strong technical reversal signals here, but this is also showing that this is a market that is kind of exhausted at this level and that needs to correct. So looking at gold right now, 1236, 1208, and 1150 are your what's the word I'm looking for? Are your support levels at this point in gold. It's range bound between 1375 on the low end, on the high end, and like 1100 on the low end, right? That's the long-term range bound. This is also, by the way, an immense base, right? We're talking here that gold really hasn't moved now for 4 years. When this thing breaks out, it's going to break out massively. We're going to see $50, $60, $80 a day moves in gold as it jumps and as it gallops away from this level. Because once the politics change in gold, once the politics change to support higher gold prices, once the sovereign debt crisis starts to truly unfold in Europe, this is the problem with a stronger dollar at this point will start draining emerging markets. It will start draining debt markets around the world. And when that happens, that's when you're going to see the dollar, gold, and interest rates and stock markets all rising at the same time. And it's going to be a shift in sentiment of risk-off assets, where stocks will become a risk-off asset like gold, as opposed to a risk-on asset, right? There's the risk-on, risk-off trade, where when you want to take more risk, you buy stocks and high yield and junk bonds and whatnot. And when you want to take risk off, you buy treasuries and gold, right? That binary market effectively changes definitions when we get into periods of extreme stress. And that's when gold makes its biggest moves. And those are the kinds of moves that gold holds on to, most of those moves, and kind of jumps and spasms up higher relative to all other currencies. And so that's why over the long run, really nothing beats gold. But, you know, the S&P cannot hold a candle to gold if you bought gold in 1971. It's $35 an ounce. Today it's $1,300. The S&P did not go up by, did not give you a what? 40 bagger? The only other asset that's given you better returns than that in the last 40 years is Bitcoin. Well, cryptos in general. How fast might interest rates rise in the UF? DTF asks on YouTube. How much over how many months? It's a good question. I don't have a good answer for it. What I can tell you is that if we get a move, what will happen is this. Central banks, the foreign central banks in general, like to defend U.S. rates every quarter point. So they always like buy to defend themselves, to defend their currencies every quarter point. 325, 350. They put up at least nominal resistance. where they buy a little bit there and then see what happens. If it's a really bad market, like I don't expect 325 to have to show a lot of support for treasuries. I think that if we start to move towards 325, we're going to move through it. We're going to move to it, hold there for a couple of days, maybe a week or so, and then go to 350. And I think we'll see more. I think we'll see more support at 3.5% or 3.75, and certainly 4% than we will see at 3.25. That's what I think. I think we're looking at, if we get a real move here, we'll see at least a 75 basis point move in the U.S. Treasury market over a matter of a few weeks, if there's any kind of radical unwinding of European sovereign debt yields. Okay, because remember, the higher that U.S. rates rise, and the higher that the higher it has to pull German bunds, and if it's pulling German bunds higher, it's now got to pull. It's also going to exponentially pull Italian rates higher and Spanish rates higher. So, being short treasuries here, at least as a short-term trade, because I do think that when we get into a real dollar liquidity crisis and a real bank capital, reserve crisis, right? When banks start to fail, they're going to be like scrambling for tier 1 capital assets, and those tier 1 capital assets in Europe and the United States are sovereign debt, even though sovereign debt's the thing that's breaking down. So if European dollar sovereign debt's breaking down, the first thing they'll do is they'll run to short-term U.S. treasuries, okay? Which is why I'm not particularly, I don't really buy a long-term flattening of the U.S. yield curve. I think that we'll see spasms of it, right? Like this article on Zero Hedge today is talking about, the record short position in euro-dollar markets could easily see the yield curve flatten as short-term rates rise faster than long-term rates. Fine, fair enough. But then once that short position is unwound, then you'll see the central banks come in and buy short-term maturity debt in order to stay liquid so that they can continue to defend their currencies. Okay. It's a multivariant problem. It all sounds like gobbledygook, but the truth of the matter is that it's the order of operations that's important. I don't have a crystal ball. All I'm doing here is telling you what could or could not happen and how quickly. No one has a crystal ball, not even Martin Armstrong. But when they start to go, they're going to go quick. They're going to go faster than people expect. And it's going to start with a rising European sovereign debt market, which is going to rise much, much faster than the U.S. markets. Simply put, the U.S. markets are bigger, and therefore they take a lot more money to move. So if everybody bails out of Italian debt, it's not enough to measurably move the U.S. Treasury market. So, any other questions? While I kind of fill time while I wait for those to show up, because there's about a 30-second delay between questions and answers and all that. But I do recommend that you try and read that article. I've got linked to Zero Hedge down below. It's really technical. I had to read it twice. I know this stuff, and I had to read it twice to truly get what the guy was talking about. But this is one of those great opportunities to learn something, and not just where Zero Hedge is still doing good investigative financial reporting of the technical aspects of the markets. So, but interesting. Interesting, Hisenburn, that you bought the Qatari investment fund back in January 17. I was actually looking at, and I didn't make the call, but I put the notion in people's heads to buy the bottom right after the Saudis put the boycott on them, and saying, but what I wasn't willing to do, I wasn't willing to buy I wasn't willing to buy QAT until they cut their peg to the dollar. If they had cut their peg to the dollar, I would have gone all in, because at that point, you would have gotten a true bottom, and you would have bought the bottom after the currency peg dropped, and you would have gotten it for a song at like $8 or $7 or some shit, and then you would have bought it there, and then once the currency started to stabilize in the opposite direction, you get both currency and price appreciation as the stock market started to rise. When the country was no longer effectively financially embargoed. because it was as long as they survived. And I always said that as long, and this is true of any country under any kind of foreign economic sanction. Okay, and this especially goes for Iran and Russia. The longer they survive without any kind of political regime change or debt default, the less effect the sanctions will have in the future. And this is why we're reaching that moment where the Europeans may actually tell Trump to go stuff it over the kinds of egregiously over the top sanctions policy that he's threatening them with at this point in time, because they're looking at Iran having already survived being cut off from the SWIFT system. They're looking at the 4 years that Russia has survived, if not now thriving and being a capital inflow destination since the sanctions were first put on after the reunification with Crimea. And then it doesn't hurt that, you know, Putin's just putting on the charm with Merkel. They just opened up the Kerch Strait Bridge to Crimea, this $3.5 billion project that they put together in less than 2 years to 3 years, or 2.5 years. And yeah, I mean, it's insane. But, and to give you an idea of what the market thinks of what's going on in Russia, I'm gonna give you an idea. So I first recommended for my subscribers to Resolute Wealth, my newsletter from that I had with Newsmax from 2014 to 2017. One of the first things I did was I put Gazprom in my portfolio. The second thing I did after that was after the ruble crisis of late 2014, I told people to buy the Russian stock market, because I knew that a ruble trading at 80 to the dollar was unsustainable. It wasn't real. And Hisenberg, I'll get to your question in just a second. You know, you could buy the Russian ETF. We still have it on here, the Van Eck Russian ETF. We put it in the portfolio at, where did we put it? We put it in the portfolio right around here at about $14. Been collecting like a 5% dividend. Now that portfolio no longer exists, but to give you an idea, and this is with the Russian ruble continually being put under sanctions pressure, and you're still looking at a solid, you know, 60% return on investment plus a 5-year compounded dividend. It's like a 75% return on, or 85% return on investment. It's a beautiful play for 5 years. Very solid return. Yep. And the MySex is showing absolutely zero long-term breakdown. Yeah, every once in a while there's a headline that causes or, you know, that causes some downdrafts, but this is a generational bull market that's starting in Russian equities. I'm not betting on Russian sanctions lifting either. I'm telling you, at this point, it doesn't matter. The Russian economy is now almost completely decoupled from the United States dollar. They don't care. Am I concerned that current U.S. politics and policy is unsustainable and risky? I am. Very. There's no doubt. But at the same time, we still have a tremendous amount of power because we are still the world's reserve currency. We're still the world's most vibrant and dynamic economy. We still have the deepest capital markets. We still have the bulk of the world's debt is denominated in dollars, which is why in many ways Trump is trying to use the sanctions hammers the way he is. And the question is whether or not, you know, Russia's already stood up to them, de-dollarized their economy. They paid off all the dollar-denominated debt. It didn't work. I mean, the ruble crisis of 2014, early 2015 was designed to depose Putin from power, and it didn't work. He's still here. He's stronger than ever. And they're trying to play the same game in Iran right now. And I can tell you that his opposition to the globalists and his horrible treatment of Merkel and Macron, which I agree with. I hate Merkel and Macron. I despise the European Union, but I despise the globalists to back it. But at the same time, the enemy of my enemy, but I don't like Trump's policy trajectory either at this point in time. So I'm enjoying watching them fight it out. And if the globalists decide to stand up against the United States' policy here, that's a good thing, because at the end of the day, the Russian, China, Iranian triumvirate axis, which is, by the way, the best chance for the world to de-escalate and become more peaceful over the course of the rest of the century, even though the Russians are not, even though the Russian government isn't great, even though the Chinese government is not great, even though the Iranian government's not great. But that alliance there is the great, and the Belt and Road Initiative and the economic integration of those countries with Central Asia and the ending of U.S. chaotic policy in Central Asia is good for the world. We are still the world's most vibrant economy. We still have the most Riverboat asks what I mean by that. We still have by far the most, what's the word I'm looking for? The deepest division of labor, the most nuanced division of labor in the world. We still produce a tremendous amount of the world's necessary, innovative capital. Russia does not necessarily need higher oil prices, though. Hisenburn. This is, I will make I'm going to remind you of this. Okay, the Saudis are the ones that need $90 a barrel oil. They're the ones with a structural imbalance in their economy and in their demographics and the way the money is what's the word I'm looking for? Doled out, right? Where the money is spent. That in order for the House of Saud to stay in power, they need to effectively bribe their people to not revolt by creating a very expensive entitlement program, which was only designed to keep them from revolting. It wasn't designed to keep them from actually becoming a modern economy. That's one problem. JKL 33. I love your comment. We should focus on keeping our economy vibrant instead of sabotaging others. Exactly. Now, I think that's part of what Trump wants to do, but he's got to stop the insane trade war stuff. But no one's listening. He's not listening to anybody on that. He thinks he's right. He's a mercantilist. You can't argue with mercantilists. They're just crazy. So the Russians are the ones that can produce oil at by far the lowest rate imaginable, and with a free floated ruble versus the dollar. Okay, the Russians pay their bills in rubles. This is why I went long Russia in 2014. If Putin hadn't free floated the ruble in 2014, I would have said that they're done. He's gonna get regime changed. Russia's over. The United States won, but Putin didn't. He did exactly what he needed to do. He did three things that were incredibly important. He shifted investment capital out of the oil sector through an economic quote unquote liberalization program, which has now borne real fruit, and it will bear fruit for the next 20 or 30 years. Opened up ruble and yuan swap lines with China in order to stabilize their internal financial markets and to get dollars into the system and to get dollars into the country in order to pay off various companies who were no longer able to roll over their debt because the United States cut them out of the Western banking system. And the third thing he did, the most important thing, was to free float the ruble. Because remember, Russian companies pay their bills in rubles. They don't pay their bills in dollars. We American investors care about our rate of return on Russian assets in dollars, but the Russians don't give a shit about the number of dollars they earn in order to pay their workers. As long as they're getting enough rubles, they're good to go. So their interest rates are insanely high, and we can and falling, and that's all we care about. So I'll get to that point in just a minute. Now, And I'll be happy to bring that point up. And it's a matter of fact, I have extensive criticism of the Bank of Russia's interest rate policy. I think they're a 1.5 behind the curve. Well, my honest opinion. I think the reserve rate should be somewhere around 6%. And I yelled at Nabiulina all last year, the Russian the head of the Russian central bank. I yelled at her all last year publicly. Not that anybody listens to me, but I yelled. The voice is getting bigger, right? When I first yelled about this last summer on Seeking Alpha, nobody was listening. 300 people read the article. I still got paid my $35. But the Russians can pump out of the ground and pay their budget deficits and pay the budget tariffs and all of that at $20 a barrel. The Saudis can't keep their budget from blowing out at anything less than 90. The Russians set their budget for this year at like $50 a barrel or $45 a barrel. Okay? So $75 a barrel, they're running a massive budget surplus right now. But operationally, no. Rosneft can pull oil out of the ground domestically for $20 a barrel. Their actual honest to God cost is like $9. Then the government takes a certain amount. Yeah, the iPhone. What the fuck are you talking about? Seriously, you don't think that the American economy is still producing vibrant stuff? You don't think that we have a leader? We don't think that we're leaders in chip technology still, and medical research, and chips technology, all of this? You don't think we're still leaders in that stuff? Really? Yeah, I mean, look, Heisenberg, don't get me wrong. There's plenty of arguments against a massive bull market in Russian equities. The United States is doing everything it can to slow the Russian expansion. And I would even argue that a lot of the opposition to an expanding Russia exists within the Bank of Russia itself, which is why interest rates are still too high. Okay? But I can tell you that Putin has done a great job of navigating that area of corruption within his own government or within the Bank of Russia and the banking system pretty well. It's still not fully under control, but it's better. What is the status of oil production in Mexico and Venezuela? Mexico, I think, is their production is strong. Venezuela is a mess, and the whole thing is collapsing. The Mexican peso is getting ready to break down in a way that could be ugly and actually could be quite politically dangerous. We still have an $18 trillion economy. I mean, don't get me wrong, China's catching up to us really, really quickly. And I'm not saying that advantage is still there, is still as large as it used to be, or is not disappearing. This is part of the reason why I'm not a bull on the United States in the long term. This is why I don't even think the United States is going to survive politically the next decade, if you want my honest opinion. But I know the story about all that stuff. But I also know a lot of the stories that come out of Russia are horribly tainted for a particular conclusion. Let's just put it that way. So it's a hard thing for Americans to wrap their head around the Russian markets becoming less corrupt than the American markets. It's hard. It's hard. Russia was lawless when Putin took over. Yes. China's investments are paying off. We have we have hollowed out our middle class. I'm not saying that our advantages will last much longer. I think that a lot of the things that Trump is trying to do, I think, are absolutely the right thing to be doing. I'm not really much of a critic of his domestic policy. I think tax cuts were good. I think the Scott Pruitt is doing a great job at the EPA. I think even Betsy DeVos is doing a relatively good job at the Department of Education. I think that most of these, I think just literally just the cost-cutting, red tape, destruction, and everything else, I think the biggest problem he has, of course, is the fact that he doesn't have a real majority in the Senate. I mean, it's not a real majority. It's a majority on paper, but John McCain's not a Republican. Susan Collins isn't a Republican. Lisa Murkowski is not a Republican. Lindsey Graham's not a Republican. But, you know, Brazil is a mess. And part of the reason Brazil is a mess is because, now look, there are GDP growth rates in areas of the world that are far more vibrant than ours. Don't get me wrong. But when you talk about let me ask you the simple question. Ready? As much as we may hate JP Morgan, who would you rather go to for financial services? JP Morgan or some guy in Nigeria? Okay. GDP growth rates in emerging markets in 5 to 9% happen. They happen because of currency printing. They happen for any number of reasons. They happen simply because Americans fart out some money and throw it into an emerging market, and we burp out a couple of $1 billion and we raise GDP by 3%. I mean, it's not hard. It's just math, because it's just gross national spending. Okay, don't get me wrong. I'm not denigrating these places. Okay, we have a tremendous amount of expertise in things, just bare bones, everyday stuff, how to get stuff done at a business level, at an organizational level, that these countries don't have. I studied Vietnam for 3 years, guys. Okay, I can tell you that the biggest thing that most Vietnamese, in 2013, I knew more about Vietnamese small caps than you guys would ever know about any one American large cap. Literally, okay? I was studying this stuff and writing research reports on them and everything else. And I can tell you that the main thing that every one of those companies was lacking was just simply professional leadership. These people didn't know how to run a business properly. They don't have any financial training. They barely know how to do that. A lot of them just don't know how to do double entry bookkeeping, for fuck's sake. Or how to calculate a WACC, or how to decide how to properly decide how they're going to grow their business, either through selling equity or selling debt or buying debt. They don't know any of this stuff. Okay? And so much of that is there. I mean, in Indonesia under Obama was growing at 7, 8, 9% a year, because Obama was preferentially flooding the market with a U.S. investment via the U.S. government and the Exim Bank. But he didn't flood them with professional bankers. He didn't flood them with professional risk assessors. He didn't flood them with anything else. You know, these people don't have proper insurance markets. They don't have good property rights. They don't have, there's so many basic friggin' things that we take for granted in the United States that are not there in emerging and frontier markets. Okay? And while we may, as investors, go, hey, I can take a risk on a flyer on buying, a Nigerian ETF, and maybe we'll do good. You probably will do good if the money's flowing in. I'm talking about, when you start talking about the most vibrant, deepest, most diverse division of labor, that's what I'm talking about. Okay? Now, China's catching up very, very, very quickly. There's no doubt in my mind. The Russians are going to start rising very rapidly in a way that is going to scare the foreign policy establishment in this country, because they have absolutely zero way of stopping it at this point. Their last way that they can slow this down is sanctions policy plus a Bank of Russia slow rolling the lowering interest rates to meet the risk profile of the country. Hisenburn, I'll give you a perfect example. I'm going to pop something open for you that I'll bet you've never looked at. Again, let's look at bonds. Okay, I'm going to go to the bonds. And I'm going to bring this up real quick. So let's go to the desktop, Bing, Europe again, search. But as opposed to stopping at Italy this time, I'm going to scroll all the way down to Russia. And I'm going to show you, can you guys see that? I'm going to make that as big as I can. I'm going to show you the Russian yield curve. So everything that's less than 1 year maturity in the Russian yield curve, and this is really basically the interbank market. Okay. And the reserve rate for Russia right now, I think, is either 7% or 7.25%. Can't remember if Nabiulina dropped it to 7% on. I think she might have. Notice that interbank lending is literally at the bound. Now look at Russian sovereign debt from 1 year out to 20 years. Okay. 2 months ago, this was a flat yield curve with a bulge at 5 to 7 years. Now we have a properly rising yield curve all the way out to the 20 year, just about. And notice where it is. Notice where the 1 year the bond is. It's a 0.5% lower than what the what the central bank is selling debt at. This has to end. This needs to drop to 6% so that we can get it properly, or even 5.5%. We need to see an overnight rate of 5.5% to get to a 20-year rate of 7.6% or 8%. And this is what it should look like. This is telling you right here. This right here is the first time we've seen this since 2015, a properly rising yield curve in Russia, meaning risk markets are now risk profile makes sense. Now when the Bank of Russia lowers rates again, all of this is going to change all of this is going to change properly. And now savers and investors and everybody else will be properly remunerated across the risk profile. It's something that you have to look for. And I've been watching this carefully for the last 4 years. Trust me on this one. I mean, I've got articles going back 3 years talking about this shit. So just to give you an idea. All right. We're at the 1 hour mark. I think it's about time for me to go. I don't really like to do these for this long, but questions have been good this morning. It's been a good back and forth. And I really appreciate it. If you guys like what you heard today, that's great. You can subscribe to my blog over at goldgoatsandguns.com. Go ahead, and if you're on Periscope, go ahead and go ahead and subscribe to my YouTube channel as well. If I can get to 1,000 subscribers, I can then force YouTube to tell me that I don't deserve to be monetized. That would be fucking fantastic. And if you really like what you heard today, you can subscribe to my Patreon at patreon.com/goldgoatsandguns, where you can get either the private blog for $4 a month, or the Gold Goats and Guns investment newsletter for $12 a month, which has a full portfolio strategy on how to deal with all this stuff, where I go over both the geopolitics and cryptos and exclusive ideas about where we're going next, which I don't talk about in public. All right, you guys have a great day. Enjoy the rest of your Sunday, and we'll talk soon. I did not talk any cryptos today. We'll do that probably tomorrow, because that's starting to get interesting as well. You guys take care. You have a great afternoon. Keep your stick on the ice.